All right, seniors, it is your penultimate lesson in economics. I'm sorry nothing has gone the way that you planned for this year, but I promise you that the school's working hard to try to make things right one way or another. Obviously, you can't make it perfect, but they're definitely trying to give you guys something at some point to feel that normalcy and to kind of have those things you were looking for. So trust me, man, I feel for you. We've got this week, we've got next week on monetary policy too, and that's really it for our course. We'll wrap things up. We'll have grades submitted by June 1st per the school's directions, and then the rest we'll see how it unfolds. But trust me, man, stay with me. Just try your best. Try anything. Pretend like you're still going through it. Life goes on after this. You're all going to go off and either find careers or go to college or start a business, travel, who knows what, but life is definitely going to go on after this. So stay with me in the meantime here. It's just a temporary setback. It's not the end of the world, promise you that. So looking at monetary policy here, kind of convenient timing, to be honest. This is exactly what's going on in the world right now. The Fed is actively manipulating money markets to try to get us out of this COVID-induced recession. So let's look at some of the ways they do it. I'm not going to go word for word. I'll try to touch upon the big points. I know your time is valuable, so let's see here. As I just referenced, the Fed can increase or decrease money supply. A friendly reminder, M1 is the most liquid of the monies out there. It's paper cash plus things that are immediately available. Now, the money market graph, the graph we use to determine kind of where interest rates are, on your vertical axis, we have the actual interest rate. And then on the horizontal axis, it's the amount of money available in nominal terms. So that's literally how many dollar bills are out there. The Fed chooses how much money is out there, so it's a vertical line. They move that left or right depending on where they want the interest rate to fall, but ultimately they choose exactly how much money is out there. Mints make money, but the Fed controls how much goes out into the economy. So the whole thing about interest rates is that we use them to create an incentive for people to either spend money or save money. So we say the opportunity cost of holding liquid cash is what you would lose if it was being put into a savings account or something that earns interest. So we see here coming, kind of want to say out of, but in the last recession, the Great Recession of 07-09, at first we had higher savings rates, but then when we needed the economy to continue to churn forward, we lowered those interest rates to encourage people to have more cash on hand rather than to have it in a savings account. You can see that in the chart right here. So as interest rates are higher, I'll try to highlight this here, as interest rates are higher, there's going to be more cash withheld or kept into savings accounts and things like that. There's going to be less money left over for the economy. That's why when we lower interest rates towards, as we see down here, 2%, 1%, people don't have a good incentive to save, and therefore they keep their money as cash and they're willing to spend it more. That's exactly what's going on right now in our world. We want to avoid a COVID-19 recession, and so interest rates are super low because we're trying to get people to open up their wallets and spend money out in the economy. Now, of course, these changes are reciprocal of one another. If you lower the interest rate, you're going to see more money pushed out. And of course, when you raise the interest rate, you're going to see more money taken back and put into savings and things like that. You can calculate this with real money demand. It's nothing too crazy right here. I know you know how to read. Of course, this is a reflection of things like consumer spending. Technology changes how much money we hold. The ability to deposit checks remotely or direct deposit changes how much cash is on hand, people's future expectations, and then, of course, international factors as well. All of these things listed right here, they can change the availability of money and how willing we are to keep cash on hand. I don't know about you, but in a time like this where we're not sure about the economy, you're not really getting much in a savings accounts, it's kind of, you have a greater incentive to keep cash on hand, right? To have it in a checking account or on a debit card ready to spend, because you're not getting much from saving it. Now, of course, the stock market is a whole different thing, but that's not part of monetary policy, so we're going to save that for a different date. The velocity of money is cool. It's this crazy concept that you can take a given dollar bill and you can track how many times it changes hands or how many purchases it has been through in a given year. Velocity, literally the speed at which it turns over. In this example we have right here, let's say a dollar bill is spent on gas, and then the gas station uses that to pay its employee, who turns around and spends it somewhere else. You could say the velocity of that money is 3. It is turned over 3 times. There's an equation for it right here. I'm not going to have you guys do this. This is something that's much easier explained in person, but just understand that we can calculate that velocity of money. High interest rates. So if there's a great incentive to save, let's say a 10% interest rate, something crazy, it causes real money demand to fall because, again, you're more likely to save it at a high interest rate. And therefore, whatever money is left in the economy tends to rise in terms of its velocity. So when there's fewer dollars out in the economy, we see the velocity begin to increase. That same dollar bill will flip over multiple times throughout the year. Conversely, when there's low interest rates, there's not an incentive to save. And then therefore, we see velocity begin to fall. People have dollar bills just sitting around either under a mattress or in their checking accounts, not spending or not turning over, right? When there's more dollar bills available, it becomes less likely to see that velocity pick up. So high interest rates usually causes high money velocity. Low interest rates usually cause low money velocity. And then, of course, velocities follow along the business cycles as well. In periods of expansion, or of course in periods of recession, we see that begin to change. So the liquidity preference model, it's kind of the same thing as a loanable funds model. It's just the way we use to talk about how much money is demanded, how much money is supplied, and then we find that happy medium or that equilibrium point that is our interest rates. This whole diagram right here is just showing you that both models lead to the same point. So of course, this leads to the federal funds rate. The Fed targets what they want the rate to be, and then they change that money supply to make that rate a reality. Right now, the federal funds rate is super low, rock bottom. Mortgages are at an all-time low. Auto loans, I'm sure your student loans are also reflected in this. We want people spending money to try to avoid the recession. So right now, the Fed has targeted a very low funds rate. They can pump money into the economy. So we see money supply here shifting to the right. That further drives down interest rates because, again, there's so much of it to choose from. And then hopefully when this is all said and done, they'll actually restrict the money supply, and that'll cause interest rates to go back up. We're obviously a few years away from that, but for planning purposes, we will one day get to that point. So the federal funds rate, that's what the Fed loans money to the banks to. You can consider that to be the wholesale price or the rock bottom rate. Now banks, this is what they end up paying the Fed. So you see that red line there is a slightly higher amount. So they pay a little bit of a premium to get the money from the Fed. And then when they turn it around and lend it to consumers like you and I, you see the markup. So the gap to that green line right there shows the higher amount that we pay. So really, just like anything with a wholesaler and a middleman and then obviously a consumer at the end, everyone gets a little sliver of that pie. We see slight levels of markups. Short-term rates, things like a 6-month certificate of deposit and other short-term things, they tend to fall close to the Fed rate. And then, of course, long-term things like a mortgage or student loans tend to float in that higher range because, again, even though things are rock bottom right now, in a few years they won't be. So a 30-year mortgage or something like that, they really try to target what they think that average will be for the time of that loan. That's really all we've got for it. The activity for this week, hopefully I tried to scale it back and make it appropriate for, trying to do this remotely without in-classroom instruction. If you have any questions, reach out, let me know. One more week left after this. You guys got this.